Have you ever felt like you're doing everything right in the stock market, only to see your hard-earned capital mysteriously erode? You research companies, you diversify, you aim for the long term, yet the numbers on your statement tell a different, disheartening story. It's a feeling of profound disconnect, isn't it? As if your carefully constructed portfolio is caught in an unseen current, pulling it away from the shores of wealth you intended to reach. We often approach the stock market with a mindset geared towards predicting winners or reacting to headlines. We treat it like a popularity contest, or perhaps a game of chance where luck plays too large a role. But what if the fundamental reason you're losing money isn't just bad luck or a few poor stock picks? What if it's something far more insidious, woven into the very fabric of how we interact with financial markets, and indeed, how we interact with ourselves? Benjamin Graham, the father of value investing, gave us the allegory of Mr. Market. This ever-present, often erratic character offers to buy from you or sell to you every day, his moods swinging wildly between irrational exuberance and deep despair. Most investors, unfortunately, become slaves to Mr. Market's whims, allowing his daily pronouncements to dictate their own emotional and financial decisions. This dance with irrationality, both external from the market and internal from our own biases, is a primary, often shocking, reason why portfolios don't grow as they should. This isn't about forecasting the next market crash or offering a crystal ball. It's about understanding the subtle, persistent leaks that drain wealth, often unnoticed. It's about recognizing the hidden forces that conspire against your financial well-being, forces that have nothing to do with the intrinsic value of the businesses you own, and everything to do with human psychology and market mechanics. Are you truly in control of your investment destiny, or is an unseen current dictating your portfolio's fate? Let's begin to uncover the truth. In today's hyper-connected world, we are drowning in financial data. News alerts ping constantly, analyst reports flood our inboxes, and social media buzzes with every market fluctuation. It's a paradox, isn't it? We have more information at our fingertips than any generation before us, yet for many, investment outcomes seem to be worsening. This isn't a sign of market complexity alone. It's the insidious information overload tax at work, silently draining your returns. Think of it like trying to find a single, perfect seashell on an endless beach by staring at every single grain of sand simultaneously. The sheer volume of data becomes a blinding fog, a fog of war where critical decision-making is hampered, not helped. The signal, the true underlying value of an investment, is lost within the deafening noise of constant, often contradictory, information. We are trained to believe that more data equals better decisions, but in finance, this is frequently a dangerous myth. Our own cognitive biases amplify this problem. Confirmation bias leads us to seek out information that supports our existing beliefs, while the availability heuristic makes us overweight recent, dramatic news. The relentless 24/7 news cycle feeds these tendencies, pushing us to chase fleeting trends or overreact to short-term volatility. Each of these reactions, driven by information overload, acts as a hidden tax on your portfolio, eroding your capital piece by piece. The true shock isn't a sudden market collapse. It's this steady, almost imperceptible erosion caused by an unmanaged information flow. To combat this, we must cultivate a disciplined data diet. This means developing a rigorous framework for filtering what truly matters. Focus on fundamental metrics, long-term indicators, and quantitative screening. Learn to distinguish the reliable signal from the overwhelming noise. By setting strict rules for how we consume and react to market news, we can begin to plug these subtle leaks and build an investment process that is resilient, clear, and focused on genuine value. It's a humbling realization, but often the most significant threat to your investment portfolio doesn't originate from Wall Street's machinations or global economic shifts. It resides within the intricate, often irrational, wiring of your own brain. Beyond the well-known emotions of greed and fear, a constellation of unconscious biases actively conspires against rational decision-making, leading even the most intelligent individuals to make costly mistakes. Consider your investment decisions as a pilot navigating a tempest. The aircraft is equipped with advanced instruments, your data, your analysis, but the pilot's own ingrained reactions, their unconscious biases, can trigger disastrous maneuvers. Our brains, in their quest for efficiency, often defaults to an autopilot mode. This autopilot, however, frequently misinterprets financial data, mistaking market noise for genuine signals or emotional responses for logical conclusions. It's a powerful, hidden wiring that can sabotage even the most well-intentioned investor. We see this vividly in phenomena like the sunk cost fallacy. This is the irrational tendency to continue investing in a losing proposition simply because you've already committed resources to it. Similarly, loss aversion, the powerful psychological drive to avoid experiencing pain from a loss, often causes investors to sell winning stocks too soon and cling to losing ones for too long. These aren't logical choices, they are emotional programs running in the background. Prioritize prioritizing the avoidance of immediate discomfort over the maximization of long-term gain. To counteract this silent saboteur, we must become acutely aware of our own mental landscape. Implement a pre-mortem analysis before every significant investment decision. Imagine for a moment that the investment has failed spectacularly. Now, work backward. What specific biases, what flawed assumptions, what emotional triggers led to that hypothetical failure? Creating a disciplined investment checklist that forces a rational review of these potential pitfalls before any trade is executed can be a powerful tool. The shocking truth is that understanding and managing your own internal wiring is paramount to safeguarding your capital. How can you begin to rewire your financial brain for resilience and rational decision-making? Diversification. It's a word etched into the very foundation of conventional investment wisdom. We're told to spread our capital widely to avoid putting all our eggs in one basket. And indeed, a degree of diversification is crucial for managing risk. However, what if the way we commonly implement this strategy, the very definition we hold, is subtly leading us astray, acting as a silent architect of our losses? This isn't about ignoring diversification. It's about revealing the trap of diversification, a flawed application that can mask underlying risks and ultimately contribute to your financial erosion. Consider this analogy. Imagine a farmer planting 100 different types of seeds across a vast, barren field. They have immense variety, yes, but in such inhospitable soil, none can truly flourish. Similarly, many portfolios are diversified across assets that, under pressure, move in lockstep. This phenomenon, known as correlation drag, creates a false sense of security. You own many things, but when systemic shocks hit, they all decline together. Concentrated risk disguised as broad-based protection. The hidden truth is that genuine diversification isn't merely about accumulating a large number of assets. It's about owning assets that exhibit low or even negative correlations with each other, assets that truly protect your capital when the broader market falters. We've all seen how many ostensibly diversified portfolios suffer significant drawdowns during major market downturns. This isn't a failure of diversification itself, but a failure in its implementation, a shallow understanding that misses the core principle. To build a truly robust portfolio, we must move beyond simply counting the number of holdings, learn to analyze correlation matrices, understand the true drivers of asset class returns, and identify genuinely uncorrelated assets. Sometimes, this might mean concentrating capital into a few high-conviction, fundamentally sound investments that possess wide economic moats, rather than spreading it thinly across a vast, homogeneous pool. The shocking reason for loss here isn't a lack of diversification, but a profound misunderstanding of what it truly entails. How can you construct a portfolio that genuinely protects and grows your wealth, rather than merely spreading your risk until it becomes insignificant? We are often conditioned to trust what is popular, what is widely accepted. In the realm of finance, this translates into a deep-seated reliance on conventional wisdom. We listen to financial news, read analyst reports, and observe what the majority of investors are doing, implicitly believing that safety lies in numbers. But what if this very reliance, this trust in the crowd, is not a shield, but a sophisticated trap designed to lead you to predictable losses? This is the value trap of conventional wisdom. Think of the herd mentality in investing. It's like a flock of sheep content to follow their leader, unaware of the precipice that lies just ahead. History is replete with examples where the prevailing market consensus, the popular narrative, led to catastrophic investment blunders. The truly shocking truth is that often the path to superior returns lies not in following the crowd, but in developing a contrarian perspective, one rigorously supported by data and independent analysis. A pervasive myth suggests that popular stocks, those everyone is talking about, are inherently safe. We see this play out constantly. The narrative surrounding a hot sector or a well-known, beloved company can inflate its valuation far beyond its intrinsic worth. Investors pile in, lured by the perceived safety of popularity, only to find themselves caught in a classic value trap. They buy high, expecting continued gains, but the reality is that the market has already priced in an optimistic future that the company's fundamentals cannot support. To escape this trap, you must cultivate an independent investment thesis. This involves moving beyond fleeting sentiment and media hype. Learn to conduct deep fundamental analysis to truly assess a company's economic moat, its sustainable competitive advantages. Value companies based on their intrinsic worth, not their current popularity or the latest analyst upgrade. Understand the crucial distinction between a company that is genuinely growing and a stock that is merely experiencing a temporary surge in popularity. Learn to recognize when a stock that appears cheap is, in fact, prohibitively expensive due to underlying fundamental weaknesses. The shocking reason your money is lost is often because you are following a script written by others, rather than forging your own path based on informed, independent analysis. How can you break free from the conventional wisdom trap and become a truly independent, data-driven investor. We often focus our attention on the grand gestures of investing, the big stock picks, the market crash, the economic forecasts. But what if the silent assassins of our wealth are far smaller, far more insidious? This chapter reveals how seemingly insignificant financial habits and overlooked fees, magnified by the relentless power of compounding, can silently decimate our long-term wealth accumulation, causing even successful investments to underperform dramatically. Imagine a leaky faucet in your home. A single drip might seem trivial, a minor annoyance. Yet, over weeks, months, and years, those tiny drips accumulate into a significant waste of water. In the world of finance, the same principle applies. Small, recurring fees, suboptimal financial decisions, and minor inefficiencies, when compounded over decades, can drain a substantial portion of your potential returns. This is the silent, invisible wealth leak that erodes your financial future. We must expose these hidden costs. Consider management fees in mutual funds, trading commissions, hidden charges within financial products, and the drag of suboptimal tax efficiency. Individually, each might appear negligible, but when compounded over a 20 or 30-year investment horizon, these small expenses can represent a staggering percentage of your total gains. They act as a direct compound interest killer, effectively stealing from your future self. To combat this, a proactive approach is essential. Conduct a thorough fee audit of all your current investments. Understand precisely what you are paying and why. Implement strategies for tax loss harvesting and ensure your investments are placed in the most tax-efficient accounts. Embracing a disciplined buy and hold strategy, whether through low-cost index funds or carefully selected individual stocks with strong economic moats, minimizes trading friction and recurring fees. The shocking truth is that the most significant drag on your wealth might not be market volatility, but the silent, compounding effect of these overlooked costs and habits. How can you effectively plug these subtle leaks to ensure your compound interest becomes your most powerful ally, working for you, not against you? We've journeyed through the often hidden landscapes of investment, uncovering the surprising reasons why your capital might be quietly eroding in the stock market. The shocking truth we've explored isn't about a single catastrophic event, but a confluence of subtle yet powerful forces. It's about the relentless noise of information overload, the unconscious wiring of our own brains that can sabotage rational thought, the well-intentioned but often misapplied principle of diversification, the seductive trap of conventional wisdom, and the silent, compounding drain of overlooked costs. These are the unseen currents that can pull even the most promising portfolios off course. The core message, resonating with the timeless wisdom of figures like Warren Buffett, is profoundly simple yet requires deep commitment. Always know what you own and why you own it. This isn't a passive statement. It's an active mandate. It calls for moving beyond the superficial headlines and the fleeting pronouncements of the market. It demands a deep dive into data, a rigorous understanding of intrinsic value, and an unwavering commitment to critical thinking. It means understanding the fundamental economics of a business, its competitive advantages, and its true long-term prospects, independent of the daily market chatter. By recognizing and understanding these hidden forces, the cognitive biases that cloud judgment, the correlation drag that masquerades as safety, the allure of popular narratives that lead to overvaluation, and the insidious creep of fees, you are no longer adrift. You are equipped to build an investment strategy that is not only more resilient, but also more rational and, crucially, more profitable. This journey is not about finding a magic bullet. It's about continuous learning, about cultivating the courage to question the status quo, and about arming yourself with the analytical tools necessary to discern signal from noise. It is about reclaiming your capital by moving from blind spots to a position of informed, strategic clarity. What is the first step you will take today to truly know what you own and why you own it?